Alright, this is Damon Varial from StockBarometer.com and from DamonVarial.com. Today I'm going to open a beer and I'm going to tell you how to become a good trader. Now, what I'm going to do is I'm just going to give you the results from a study published in 2008 that show the determinants of a good trader. So there's this big study where they took a bunch of traders, they looked at their portfolios, they figured out what commonalities these good traders have in common. And they found out some stuff. Now this guy right here is probably not a good trader. I'll give you a few reasons why. First of all, he's not looking at his computer. He's on the phone and he's got a computer and he's screaming on the phone. He's just not focused, all right? Okay, this has nothing to do with the presentation. Also, he's wearing a really ugly pink tie. Let's move on to the presentation, okay? I need a sip. Bar beer. Product placement. Okay, the first thing this study found was that people who have bigger portfolios tend to do better. That is, the more money you have, the more money you're going to make. People know this. Common sense, right? Why did this occur? Probably because people with bigger portfolios don't have the risk of commissions eating as much of their profit margin as people with smaller portfolios. But, you know, this is common sense right here. Let's move on to something more important. What they found was the people who diversify, who put their investments into they put their investment into many different types of investments. Maybe they have bonds here, stocks there, and in the stock market they invest in many different industries. Actually, those people didn't make as much money, didn't make as much turnover, as the people who focus on one specific area. Now this goes against what we're taught by the general media, general educational materials on investing. It tells us, we should diversify, just put your money everywhere and just hope for the best because overall you're going to make a lot of money. Well, recently The Economist had an article where they showed that diversification actually can hurt you quite a bit because usually you'll have a couple industries that tank. And if you're good at picking out what industries not to be in or to stay out of, then you're probably going to make more money than those people who are just like diversification, what do you call them? People who love diversification. Lovers. Okay, that's the easy word. Diversification lovers. So, what you're going to want to do, if you want to be a good trader, is focus on a couple industries, right? Or focus on one type of security. Maybe you're an options trader, or maybe you're just a person who buys stock that give dividends. People who have a very specific, focused, targeted strategy typically are better traders than people who just throw their money everywhere and hope for the best. Don't be wealthy. Weird, isn't it? We just figured out that people with higher amounts of money in their portfolios tend to do better. But at the same time, the study showed that richer people tend to have worse off portfolios. Why is that? I don't know. Overconfidence, I guess. Damn, look at all those $20 bills. Alright, I guess, yeah, the more money you have, the less you care about how you spend it. That would be my guess. You tell me, I have no idea. I'm just presenting the findings. But really, if you're wealthy, you probably have built up skill sets in other areas such as business, or maybe you're a doctor. You probably don't have so much time to research stocks, to research investing. You probably are listening to a couple maybe TV programs or a couple tips from your friends and then putting your money in a portfolio based on that advice, whereas people who don't have so much money might have a bit more time to investigate stock, to investigate trading strategies and actually apply them during the day when you can make money day trading, or make money actually following a stock instead of putting in an order where you say good for 30 days or good for a day and then you have a price gap and that price gap makes you lose money. That could be one aspect. But I imagine it has to do more with the time aspect. Richer people tend to be busier. They probably don't have a lot of time to figure out how to invest their money, which is why they like to put their money into hedge funds. They like to put their money into whatever their investment advisors tell them to put it into. Whereas people who are using their own money to invest probably put a lot more time into researching how to invest that money. Third, or fourth, I don't know. Don't be female. Females tend to perform worse when investing for themselves. Is that sexist? I don't know. The results of the study just say females tend to invest more poorly than males. My guess is that females tend to be a bit more emotional, and any good trader knows that you cannot be emotional when you're trading. You cannot base a trade on how you feel. You cannot base a trade on intuition. You cannot exit your trade earlier than you had originally planned or earlier than your strategy tells you to. If you don't have a fixed system and you're relying on emotion and intuition, you're probably going to do worse than traders who do have a system and are, stone cold. They're icy in their approach to investing. Now, of course, not all females are like that. That would be sexist. But then again, you might find that more males tend to develop a system and trade more logically without being affected by emotion than do women. That's not to say that all women are bad traders. Of course, there's got to be enough good traders. You can't say all women are good traders too, because that would be sexist as well, right? So there's some balance there. I just have to say this stuff because this is the society we live in. We can't say women are worse traders and have that mean generally women tend to perform poorly on trading when compared to males, because that's, sexist today. But anyway, the idea is avoid emotion when you're trading. Develop a system, stick with it, don't go with your intuition, don't get afraid if you see a stock falling. Whatever your system tells you to do it. Grow old. The study found that people who are advanced in age tend to have better performing portfolios than young people. Well, this should be obvious, right? Experience. But another aspect might be, as you get older, you become more conservative in how you trade. So you're not going to put money into risky investments. And while risky investments are pretty useful if you know what you're doing, overall, people who invest in risky investments lose a lot more than they make. So older people might be better at trading simply because they have more experience, but it could also be because they trade more conservatively. Learn finance. Well, the study didn't tell you to learn finance. The study didn't look at if people learn finance per se. They looked at where the income came from. And they separated them into groups of people who were generating income via standard jobs and generating income via the financial industries. So if you're like a banker, you're going to be better at investing, they found. If you are in the financial industry, you're going to be better at investing. That's pretty obvious, right? So that means you should go to college and learn finance, right? Well, no, because what they also found was people who had gone to university tend to be better at losing money than people who never went to university. In other words, if you just have a high school diploma and you become a trader, you generally will have more success than people who had gone to university. Why is this? This is a good question. I really don't know. I would imagine a lot of people would say people who go to university don't have any real life experience. They get all this theoretical experience, but it doesn't work in the real world of trading. I'm sure a lot of traders would say that. I would say the majority of the good traders I personally know didn't go to university or didn't graduate university at least. So that might be true. They started out on the floor. They started out as a broker. They learned, from the bottom up, and that's why they're better at trading. But that doesn't mean that going to university will inhibit your trading skills. quite the contrary, it should give you a background at least so that you can start more quickly, even though you're starting later in life. So whereas a person who graduates high school might immediately go become a trader and start 4 years earlier than someone who's graduated university, at least someone from university has, the background knowledge of finance and can eventually catch up to that high school trader, supposedly. Okay, so those were the results of the study, and of course this presentation is a bit sarcastic, facetious. You're not going to base your own trading style on what we found in this study. You're not going to have a sex change if you're a female so that you can become a better trader. You're not going to throw away your money because wealthy people tend to perform more poorly at trading. You're going to take from the study the implications of those facts and apply them to your own trading strategies. Okay, that's all we got for today. So again, I'm David Varial from stockbarometer.com. There are going to be things around here, up there, or up there. I don't see my face on here. So what you're going to see is some links. Click on them. Go to davidvarial.com for a free guide on gap trading, which is my specialty of trading, where we look at price gaps in a stock. So you might have a candlestick here and a candlestick here. Between them is a price gap. You can actually make a large profit based on that price gap because price gaps are quite predictable. So go there, figure that out, and leave me comments down there. Thank you.